Okay, so today, not the greatest day for Tesla. And I'm sure if you're watching this video, you are most likely invested in Tesla in one shape, form, or another, or looking to invest in Tesla for the next rally, for the next big aha moment, whether it's robo-taxis or whatnot. And maybe you're just on the sidelines here like, I don't know where Tesla's going to go next. I don't know if now is a good buying opportunity. I don't know if we're going to fall lower from here. And to be honest, as I said in the last video, it's kind of shocking what happened to Tesla stock today. The fact that Tesla sold off, but other areas of our markets that are also interest rate sensitive, that also benefit from rate cuts. We're talking dividends, cyclicals, consumer discretionaries, real estate stocks and small caps did well, generally speaking, and Tesla acted like a big tech stock. In fact, it's not a big tech stock in that sense. Tesla portrays qualities and attributes of small caps, right? And that's why Tesla's still down 50% from all-time highs, whereas big tech has had the last 18 months in the spotlight. So here in this video, I will explain what's going on with Tesla, what you need to know heading into tomorrow. Tomorrow is retail sales, the last big set of data that we will get before Wednesday's FOMC meeting, before the Fed will cut rates for the first time. And this is pretty important information. We have Goldman Sachs that is letting us in on their projections for retail sales coming tomorrow morning. And I'll tell you right now, if Goldman Sachs is correct on their estimates, you're going to fully price in a 50 basis point rate cut by tomorrow morning, which I should point out that current probabilities are about 62% for a 50 basis point rate cut coming on Wednesday. There's about a 38% chance of a 25 basis point rate cut. So markets are leaning towards a 50 basis point cut, but you really want to see these odds be like 85 to 95% in either direction to really solidify the pricing for the Fed action. Here's the deal. Retail sales are expected by the markets at 0.2%. Last month was 1% positive. So when you're looking at a month-over-month comparison, 0.2% following a 1% reading last month is actually pretty damn strong. Now, if you were to come in negative on the low side, then you're going to further boost those odds of a 50 basis point rate cut. Now, let's be very clear about this. The Fed already knows what retail sales is. Last Thursday, there was only 14% odds of a 50 basis point cut. They had Nick Timmerhouse post that article that sent those odds from 14% to 62%. Given we have retail sales tomorrow, it's not enough yet to solidify a 50 basis point cut. But it seems like to me the Fed wants to do 50 basis points. Now, with that said, if the Fed already knows what retail sales are, let's say retail sales are going to come in strong. That would lower the odds of a 50 basis point cut. If that's the case, if retail sales do come in on the stronger side, which is good news for stocks, then you're going to need another article from Nick Timmerhouse to then boost those odds of a 50 basis point cut back up again following tomorrow morning. So it won't surprise me to see another article from Nick Timmerhouse that confirms more or less a 50 basis point cut after retail sales comes out. But if retail sales come in line with Goldman Sachs estimates that we're going to look at in just a moment, then I'm not expecting another article from Nick Timmerhouse, or at least we don't need that article to then boost up the odds of a 50 basis point rate cut again, because the Fed just doesn't want to catch the markets by surprise, right? They like to do what the markets are pricing in, and they basically have always done what the markets have priced in over the last 50 or so years. That's because the last thing you want to do is surprise the markets. Like, imagine if we're all expecting a cut and the Fed does nothing, because I mean, what do you think that would do to markets? That would obviously not be good, right? Or if the Fed were to raise rates or something, that wouldn't be good. So that's why the Fed kind of forecasts what they're going to do ahead of time, okay? And if the Fed wants to do 50 basis points, they're going to make sure markets are pricing that in. heading into Wednesday. And as I've said for last week and now this week, retail sales is really the only catalyst that we have of important size to move the odds of a 25 or 50 basis point rate cut in any kind of material way before Wednesday's Fed meeting. Okay, so Goldman Sachs, they are sticking with their call for a 25 basis point rate cut at the Fed meeting this week, which I find interesting because they are expecting a 0.1% increase in core retail sales in August. They say our forecast reflects mixed card spending and a moderation from very strong growth in core retail sales over the prior 2 months, but a potential boost from back to school shopping. We expect a 0.3% decline in headline retail sales, reflecting lower gasoline prices and lower auto sales. So if we get a negative 0.3% number for retail sales tomorrow, again, that's going to boost those odds of 50 basis points. If the Fed only wanted to do 25 basis points, they need to have a story come out from WikiLeaks that strongly favors 25 basis points, or else we're going to get 50. So if Goldman Sachs is correct on their analysis of retail sales, we're going to get 50 basis points from the Fed. And tomorrow morning is ultimately going to be the catalyst, the final catalyst to solidify the 25 or 50 basis point cut. And look at that, Elizabeth Warren calls for a 75 basis point Fed rate cut this week. That doesn't look politically motivated at all. Obviously, just kidding. But seriously, I think we need to make this differential very clear. 25 basis points or 50 in and of itself does not matter. What matters is the dot plot and the Fed's tone and commentary around the economy. In this market, good news is good news, bad news is bad news. So if the Fed has good things to say about the economy, if the dot plot does not show any kind of material further weakening in the economy, that's going to be seen as good. Now, if the dot plot forecasts a bunch of rate cuts, lower GDP, higher unemployment, the Fed sounds like we could be going into some kind of recessionary period, maybe he even throws out the R word, the recession word during the press conference, that turns a 25 or 50 basis point cut into a bigger problem. Because in fact, the best time to be invested in our markets during a Fed hiking or cutting cycle is after the last hike before the first cut. So the last hike was July of 2023. So for almost 18 months now, we have been in this sweet spot for markets where inflation is falling, so the Fed doesn't need to hike anymore. The economy is doing okay, so the Fed doesn't need to cut. That is the best, kind of Goldilocks period for markets. Normally, historically speaking, when the Fed is cutting rates, that's when the economy is getting worse, and that's when you tend to see sell-offs, recessions, and volatility in markets. And given that historical context, I think it's probably likely that we do get a sell the news event coming on Wednesday, especially if markets don't do much selling heading into Wednesday, which the S&P is basically flat today, so you're really not doing much selling. Now, the last Fed rate cut that we had that was just the start of a normal easing cycle, not the Fed panicking, was August 1st, 2019. Yes, there was definitely some influence from Trump at that time on Jerome Powell to, start cutting rates. And that definitely weighed on the Fed's decision at the time. But August 1st, 2019, the Fed cut rates 25 basis points. The S&P fell 7% within 4 trading days. Just simply because when the Fed cuts rates, it's usually the time to take risk off the table. That was a classic sell the news event. I could see why people would say 50 basis points would be bullish, right? Because you're going faster to get back to neutral. There presumably would be less odds of a recession. But I do think to some degree the algorithms are already pre-programmed to sell the first Fed cut. The question really is, how bearish is the Fed? How hawkish is the Fed around the economy? And that is something that we will not know until Wednesday. Now, I can tell you again why I was surprised today Tesla stock underperformed when dividends, value, cyclicals, small caps all did well, is because you would expect to see that heading into the first Fed cut. Tesla is an interest rate sensitive company. It is a cyclical company. If the economy does well, Tesla will do well. If the economy does not do well, Tesla will not do well. That is the definition of a cyclical company. Take a look at the RSP. The equal weight S&P is up 0.65% today. The S&P is basically break even, the market cap weighted S&P. I would have expected Tesla to outperform with the, interest rate sensitive companies. Now, if the markets do take the first Fed cut as positive, Tesla stock, in my view, will outperform. It will do very, very well. And in fact, if the Fed does give us a dovish 25 or 50 basis points, then I think that actually sparks a rally in Tesla stock heading into the October 10th Robotaxi event, where Tesla stock could be a $300 stock by midpoint of October. But again, with the Fed cutting rates, there's also other things like the election coming up, in which we have not priced in any election uncertainty. Whether you're looking at tariff policies or raising the corporate tax rate, that's not going to be positive for corporate earnings coming next year, either which way things go. And with earnings estimates for 2025 sitting at still all-time highs, you're priced for perfection when we're going to experience far from it. And it wouldn't surprise me if a sell the news event is then coupled with election uncertainties and maybe the realization that earnings estimates are too high for 2025. Also, keep in mind the second half of September is the worst 2-week period for markets historically, and September over the past 5 years has had an average return of over 5% negative, in which at this point you're basically break even for September. So to see something in the neighborhood of a 5 to 10% pullback by the end of September would not surprise me, and it shouldn't surprise you. Ultimately, I think you should be prepared for it. I think that's probably the most likely outcome. Now, in the event markets roar higher, you wouldn't want to be in big tech. Big tech is the last place you would want to be. You would want to be in small caps and Tesla and cyclicals and value, consumer discretionary. And I think that is a good way to hedge bets as well. Potentially, short S&P, long interest rate sensitives. That could be a good play here. Although I'm not a financial advisor, that's not financial advice. That's something I will look into within the trading community. Check out that link down below in the description of this video. We also do have a pretty big play on bonds, which bonds are doing pretty well today, up almost 1%, hitting almost a new at least 1-year high on TLT. I think TLT can do very well here. But again, this is not just blanket financial advice. If you guys want to see what I'm doing, what we are doing in the trading community, check out that link down below in the description of this video. But I do think cash is king if you're ultimately undecided on what you think is going to happen in our markets. I don't think you can go wrong with cash at this point with stocks this expensive. But potentially there are some strategies that could make a lot of sense if markets do go higher, or if markets do go lower. So these are kind of just my thoughts around this. I think tomorrow's data will be very important, and it wouldn't surprise me if we see a big reaction in markets as well. So you guys have a great rest of your day, and I will see you in the next one.